being an attorney also, I love the legal chapter for obvious reasons. Starting next week, we're building a foundation where we're coming up with audit objectives, completeness, things of that nature. And we're going to use those so we can help to understand how we set up audit programs for different stages of the audit. So you'll notice Chapter 6, Audit Responsibilities and Objectives. Then we talk about the fascinating relevance and persuasiveness of evidence. Then audit planning, and there's a big stress, and this is big on the exam, and I don't like their answers, about analytical procedures. So I'll be giving some hints next week so you can answer those questions correctly, but I don't really agree with some of their answers. To me, analytical procedures are at all stages of the audit, and on those exam questions, they only wanted at 2 of the 3 stages. So I'll tell you how to get the exam question right, but I'll also tell you more how to proceed from that perspective. Notice when we get to week 4, we start into specific subject areas, like the auditing of cash. Okay, so first a general question. Are unethical practices always illegal? No. No, definitely not. Definitely not. Now, the textbook here, and I know, boy, this is, Joan has a lot of stuff marked in here. Talk about people. Well, why would people want to act unethically? Remember, we have something down, and one of the topics I put in the online discussion was rationalizations for fraud. What were some of those? Some people have addressed that. What is some rationalization for acting for fraud or for unethical conduct?
They needed the money for whatever reason.
Yeah, okay, yes, and I'm being underpaid,
Yeah,
so this
that's
is
a
just
huge one.
making it even with my abilities and the work I'm doing.
And what I should have got paid for, raise a merit increase.
No, I agree with that.
Being concerned about work goals or, like performance.
Well, it could be like I didn't receive an adequate performance review here, so I'm going to engage in conduct that I think will assist me in impressing the boss, which doesn't necessarily mean more competent behavior. It might be more playing up to the boss. I'm sure you've all encountered that in a job, or you will someday down the road. I could speak from personal experience on that as well, but it won't. Or, well, other people are doing it, so, I mean, why can't I do it? That's the old idea for tax purposes. Well, you said I can't deduct expenditures at my personal residence, like putting on a new roof, but all the neighbors did it, and they didn't get audited, so it must be right. So they talk about some of that, and that's in here on page 80. Everybody does it. If it's illegal, it's ethical, which of course, there's not a direct relation. One thing that Joan has marked here, and I'm not going to do this, there's an ethical dilemma that's on page 80, and she has down here for her classes, read it to the class. But the only thing I want to mention here is this. The situation they had on page 81 is very reminiscent of something that I personally encountered in public accounting. You are assigned a duty. Let's say you're a senior level person, so the manager comes to you and assigns you some research and says, don't charge more than 10 hours to this client. And to do the research to your satisfaction, you spent more than 10 hours. There's a dilemma there. Now, they're showing a way of approaching a dilemma, and I don't care about that. But what are the possibilities here that you could do? You spent 13 or 14 hours. I told you as your supervisor, don't charge more than 10 hours to this client for this project. What are your alternatives?
Do the 3 hours on your own? not charge it?
That's right. That's one of the alternatives, swallow the time. Swallow the time.
Or do what you can do within a 10-hour period.
Okay, but then I haven't completed the project satisfactorily.
You go for the 10 hours and tell them that you have to do this, and it's gonna take another whatever hours.
That might be beneficial. I hadn't considered that, letting them know that there's some unforeseen difficulties that arose and explain what they are. Or what else could you do?
You could always bill them for 13 and discount it for 3.
Or yes, I show them the entire
to
amount.
show the, to show the time that was, used.
Now, when this happened in Arthur Anderson, the official firm policy was you charge the time, all of it. Did I ever swallow time? Yes, because that got me promoted more quickly. But it's an interesting, I like your idea perhaps going to the manager when it's getting close to like the 10 hours and saying, I'm not going to be able to do it satisfactorily within that time period. Can I charge more time?
Manager will probably say, well, that's one of the time.
Well, they may say that, and I know that that's officially that's not the policy you should take, but it could really be beneficial. I remember at Anderson, I started with a group of people, then I got called away for a year for active duty in the military. Then I came back and I did swallow time occasionally, put in extra time that I didn't charge, and then I got promoted with those same people I started with, even though I'd been gone for a year. So I think that was beneficial, but the official policy of the firm was charge all the time. Yours might be a way of modifying that. So I just thought this was an interesting situation that was here in the text, because it's something that you could encounter. And that could be true in any firm where you're charging a client with hours. So it could be in a law firm, for example, as well.
Getting
Yes.
promoted with kind of a group of people at a accounting firm, is that kind of how they do it? Or is that like how they do it at a law firm? Because that's what, I mean, a law firm
Yes,
kind of
yes.
have a class that everybody...
Although there's more classifications at a CPA firm. You know, your inexperienced assistant, experienced assistant, senior, sometimes there's a supervising senior, then manager, and sometimes there's 2 levels of partners in a CPA firm, whereas there's less levels in an accounting firm. It's just an idea, and you came up with some interesting suggestions here. Now, they have a way of approaching the issue here, and you can kind of read through that on your own.
Is it possible for someone to act unethically simply out of ignorance?
Perhaps. Lack of competency. It's, for example, like when you're auditing financial statements and you see blatant mistakes. Automatically, we presume that somebody was doing this intentionally, to maybe cover up a misappropriation, for example. But it could just be ignorance or incompetency as to why the mistakes were made. So that's not an excuse.
Right.
Although there would be no fraud there, because fraud requires intent.
Yeah.
There's no intent.
But even unethical means you're acting selfishly. You're doing something to benefit yourself. So I don't think I agree with it.
Well, that could be, for example, the old WITTB on a balance sheet. What it takes to balance. Somebody can't balance out. They want to turn something in, so they put a fictitious accountant with a numerical amount on either one side of the balance sheet so it balances. So that is possible, certainly. Now, the ethical rules of the profession, you might say, well, Bill, how did these rule numbers come about? Well, there's some rules that used to exist that no longer exist. One of the issues that I raised in the online discussion that somebody addressed dealt with advertising. Advertising was never allowed in the accounting or legal professions. And now advertising is allowed. That actually comes from a Federal Trade Commission report. I've got a copy of it here from back in the 90s, early 90s. So a lot of things have changed. When I was at Arthur Anderson, I was talking one time and saying, why don't we call 69 West Washington the Arthur Anderson Building? Because we were the largest firm that was occupying the most floor space in that particular building. And they said, well, no, that's advertising. We're in the accounting profession, we can't advertise. But that was back in the 70s. Now you could put Arthur Anderson on, well, if we're still around, you could put that on the building, and that would be acceptable. Okay, they give some ethical principles in here, but let's go basically, I want to skip to the rules. Now, some of you, page 88, some of you have already done some posting, and this might be the most favorable aspect of Sarbanes-Oxley, indicating the activities that you cannot engage in for an audit or attestation, which is kind of like auditing client. Without looking at the text, what are some of those activities that you can not engage in? Let me comment a little while you're thinking. Back around 2000, there was a big dispute between the legal profession and the accounting profession on an issue called multidisciplinary activities. The CPA firms were going to make themselves one-stop shopping. They were going to have their own legal department. They were going to have like an insurance department, a pension. They were going to have all the activities within the responsibilities of the accounting firm. Attorneys were angry because even though in the accounting firms it would be registered attorneys performing the services, they'd still be working for an accounting firm, and that would take business away from the law firms. Well, Sarbanes-Oxley eliminated that multiple disciplinary activities because now you can't engage, for example, in legal work. But what are some of the other areas that CPA firms were engaged in prior to Sarbanes-Oxley that they cannot engage in now? Well, when I was at Anderson, we did the tax work for, remember the old First National Bank in Chicago? It's been through numerous changes and acquisitions. Now I guess it's Chase. Is that what became Chase? I think so.
Which company?
First National Bank of Chicago.
Yeah, Chase.
Is that Chase now? Okay, but it's been through several different stages. And I remember we did not just the audit of the bank. We did the tax work for the bank, and we did the tax work for the executives of the bank. If you do an audit, can you do tax work for that client? Yes, if it's just for the corporation itself. But you can't do tax work now for the executives of that particular firm. So it means you still, if this were back in that era, you could still do the tax return for the bank, but you couldn't do it for the executives. That was uncertain. When Sarbanes-Oxley first came in, there was uncertainty whether or not tax services could be provided in any capacity. I remember reading numerous articles about that, but then they decided that yes, you could do tax returns for that particular client only. But we used to do actuarial work, we did insurance work, we reviewed pension plans, all those. Can't do it anymore.
So I have a question for a private company, right?
Okay, privately held.
Privately held. We have a CPA who does the financials. It's moving over to me. So she's going to be, she has to wait a year or whatever it is so that she's not doing the financials because she can't audit us until she's not independent, until she's independent. But she does income tax for us, and then also she does it for the owners.
And that is acceptable. In fact, I have an article, maybe I'll bring it in next week. It's called Cherry Picking Sarbanes-Oxley. And it says privately held companies do not have to follow Sarbanes-Oxley, or they can pick and choose which sections they want to adhere to. So that would be perfectly lawful. In fact, in theory, although it would be a rotten idea, she could prepare the financial statements and then audit them. Now, obviously, I would recommend that because you're reviewing your own work.
Yeah, because she doesn't want to do that. So
By
she's
the
trying to
way,
give it out to me.
could we have if we are a publicly traded company, could we do write-up work, which is financial statements and things for a client, and also do their audit,
No.
even if different people were involved?
Well, I
No.
know if you're doing the journal entries, you can't. do
No,
an
no,
audit.
again,
Right.
that's write-up work is not allowed. Again, privately held companies, yes, publicly traded companies, no. And that was something that was not uncommon. Now, usually that was done in the small business division of a major firm, where we used to do some write-up work for companies. And then there were also audit clients. They were publicly traded companies, but they were not the shares were not widely held. And oftentimes they needed audits and things in order to be able to get bank loans and things of that nature. So they listed some of the things on here in the text: bookkeeping services, that's the write-up. Appraisals, actuarial services, internal audit outsourcing, HR functions. Now, I don't remember a lot of HR work being done by the public accounting firms. Investment advisors, legal services unrelated to the audit, and so forth. That is probably the most advantageous part of Sarbanes-Oxley. Although we did find out, remember, in an article that Letitia came up with about eliminating all of Sarbanes-Oxley. But the greed that was being generated because of more lucrative consulting services is what gave rise to the Enron WorldCom situation to begin with. So I kind of think this is beneficial. And notice CPA firms are not prohibited from performing these services for private companies or public companies that are not audit clients. That's another issue. You can take a publicly traded company that has another auditor, and you can do these services for them and maybe generate some rather lucrative fees for doing that particular service. Now, one thing that's going to be perhaps on a midterm exam question, so we'll talk more about it next week. Some of you have posted on this, and that deals with the audit committee. What is the main function of an audit committee for a publicly traded company?
Make sure they're following all the accounting standards, everything.
And to be a coordinate exactly with the auditors. In fact, remember Bill's ex-wife, father was lived out on Long Island in Suffolk County, and Helen's family was relatively well off financially. Helen's father, who had run his own insurance and real estate firm, was a member of the board of directors and on the audit committee for a major New York City bank. And once, I remember this was back in the 80s, once a month he would travel on the Long Island Railroad down to New York City, spend the day when the audit committee met. And he would come back and talk to me a little bit, not giving out confidential information, but about some of the activities. So he certainly was kind of involved. And that's something that's essential now. Now that occurred well before Sarbanes-Oxley. For any stock that was traded on the New York Stock Exchange, you had to have an audit committee with some of the requirements that you have been posting in the online discussion. Now it's mandatory. So it might have affected some companies whose stock was not traded on a national exchange, or maybe was traded on one of the other exchanges that didn't have those requirements. But it is a good idea to have that as kind of a liaison between the auditors and the company. I remember Mr. Wharton always talking about, well, the Jewish accountant did this or something. But I will say that he did pay attention at these meetings. Oh, by the way, that was 12 meetings a year back in the early 80s, and he was paid $35,000.
Do they still do 12 meetings?
I'm not sure now because, I mean, you would think that it's nice that you'd have to have it when the auditors were out there. But I like the idea of having the meetings on a monthly basis just to keep up to date on what's happening or possible other issues that might impact the financials. Because there could be acquisitions, there could be legal issues that are going to impact what the auditor does. So the members of this audit committee being involved in that would also be beneficial. That is kind of interesting because it says in here you only have to meet at least annually. I think more than just once a year would be beneficial. Now every month, well, maybe not in the summer, but I think in all the other months it would be desirable. Now, I mentioned to you before, it was very typical when Bill was in public accounting that you worked in public accounting for, I don't know, 7, 8 years, and then you went to work for a client that was on your client list. That's what happened at CBI Industries, remember, with the head of internal audit had been the audit manager on the CBI audit. Now, as someone mentioned earlier, there is the 1-year cooling off period. This always reminds you of like the NCAA standards for athletes. If you have a scholarship at a Division I school for, let's say, football, and you want to transfer to another Division I school, you got to sit out a year, kind of like redshirting. Although if you went to Division II or III school, you could go right away. There's this cooling off period. I think it's an overreaction, but I can understand why. As an auditor, if you want to get employed by this client, you may be less objective because not wanting to alienate the client, because then they won't give you the offer, because most people don't stay in public accounting for their entire career. Public accounting involves a lot of pressure and a lot of hours. That's why it's often recommended for younger single people without family obligations, although you certainly could have family members and still go through that avenue.
What are the other choices besides public accounting at a firm? Like for a new person, say, who's a high school teacher.
Oh, okay, all right. But you actually could go to public accounting because you don't have family members right now except for a spouse. So, I mean, you might be able to put in the extra hours. The other thing, of course, I would recommend is going into industry and working in one of the accounting departments for a major corporation. Is that the route that you took originally?
Yeah.
Yeah, and then you go up to controller, CFO, something of that nature as well.
Is it less competitive?
Well, the hours are shorter. I'd say that. Public accounting hours are really severe. Except for, I mean, there is an off season. It's not 12 months a year. If you're on the audit staff, it's going to be more the probably December, January, February, March. If you're in the tax department, it would be more the January through June, probably through June 15th. You know, usually you'll get paid for it. So I mean, it's very lucrative, but it does involve a lot of time.
And it also depends on when some companies, their year end have weird year ends, because I know one company I work for, their year end was August the 30th.
Oh yes, yeah, June 30th year end, September 30th. There's, you know, you'll find a variety of year ends. Actually, I like that because that spreads the audit work out.
Yeah.
Trouble is, too many companies are on December 31st. That's why when we'll be talking about planning the audit these next few weeks, if you can do some work on an interim basis, it saves you a little bit of the time at the end of the year. I mean, there's a lot of horror stories when you're in public accounting. I remember one, this was at Minneapolis, St. Paul office of Anderson. Some people have been putting in 12, 13-hour days. And one person that was working late at night, the client had already gone home hours earlier, and didn't realize that although the elevator doors were partially open, the elevator was not there and fell down the shaft. You know, this is another one. I remember at Anderson, somebody had audit work papers, remember these were all paper then, and went out to their car, put them on the roof of the car, you know, and then, you know, unlocked the car and then took off and didn't realize the papers were on there. They went flying all over the locals' community. And some were retrieved, and basically a lot of them had to be recreated. I mean, let's face it, when you're working extensive hours, that's when mistakes are going to occur. We think about that with manual labor like factory work, but it can happen for white-collar type work as well. Partner rotation, this is another one that I have a feeling is unnecessary. It says here they've got to change the lead partner every 5 years. Well, I guess I can see what's behind it is to make the major executives of the company and the partners not too close with one another. But to be honest, partners are more public relations people. They worked their way up. They've done all the audit functions at the lower levels originally. And they usually go out to the to an audit client. I think when I was at the Quincy audit, I think the partner came out twice for 1 day at a time. One of the times he did a token work paper. Most of the time he was out golfing with the CEO or something. You know.
Is that part of the culture like it is with lawyers, where they take the clients out a lot?
Yes, although it was interesting, we would often take the clients out, you know, and then we would of course bill it to their account. But the employees didn't care because they were getting a free meal out of it.
Or charge them for the time that you're taking them out to lunch.
That's interesting. Well, but we discussed you know, accounting issues while we were there at the lunch. All right, now we start with the rules on page 90, and I need someone to guide me a little bit here. One of the most significant rules is Rule 101. That's the rule on independence. Can some people now, I just added that as a topic today in the online discussion, because I think it's an area that requires additional you know, researching. Can someone just indicate to me what the rules were? First of all, let me tell you what the rules were at Anderson. And then you tell me what the actual rules are that are required. At Arthur Anderson, several times a year, we were given a listing of all of the clients for which we did audits. And we were given 60 days in which to divest ourselves of stock at any of those clients, whether we were involved in audits of those clients or not. So when I transferred to the tax department, I could not, and I would not be doing any more audits. I could not own stock in any audit client of Arthur Anderson of any office. Now, are the rules that stringent? Is Rule 101 that stringent?
Well, you can't have any financial interest in the client, meaning stock or direct investment.
If that's true, if I'm in the tax department and I'm not doing audits?
No.
There's a distinction between partners and everybody else. For everybody else, what is the rule about the stock ownership?
You can't have any material stock ownership?
Now, is that pertain to people who aren't working on the audit?
No, so you can't work on an audit. You can't work on an audit that you have any type of financial interest in.
That's right. This is below the partner level. That's correct. So it's a much more relaxed rule than we had like at Anderson. Amanda's right. Basically, you cannot own stock, and as she said, directly or indirectly. That means members of your household as well. in an audit client for which you are doing work on the audit. So conceivably, we could all be on the audit staff, and let's say that we're doing the audit of ComEd, and Barry is not on that audit. He could own stock in ComEd conceivably, because he has nothing to do with that audit. So obviously a much more relaxed rule than we used at Anderson. So if you're below the partner level, as Amanda points out, you can own stock in an audit client as long as you can in no way influence the results of that audit. Now I'll bet the big four public accounting firms are following the more Anderson approach. What about partners though? Partners have a little tighter standard. Well, my understanding is, and if you can find me wrong, please post that, say it now, or post it in the online discussion I had of this topic today. My understanding was that partners could not own stock in any audit client of the office to which they were assigned. So if we're all partners in the Chicago office, we could not own stock in any audit client of the Chicago office, but we could own stock in an audit client of the LA office or the New York City office. Again, most of the public accounting firms have more stringent standards. So non-partner, you can own stock in an audit client as long as you can in no way influence the audit. Don't forget the direct versus indirect ownership, members of your household being precluded. Partners, only precluded from owning stock in an audit client of the office to which you are assigned. But again, I think most of the CPA firms would follow a more stringent standard. And they do mention some of this as well here in the text here. And you can go into more detail, if you could in this area, go into more detail with this new online discussion topic that I added today to the first computer screen. Oh, what about this? Can an audit partner be named to the board of directors of a client?
No?
How about to a nonprofit?
Yes.
Yeah, the answer there is yes. Let me comment on that. They talk a little bit about it here. Director, officer, etc. You can be a member of the board of directors of a client as long as you could in no way influence the results of the audit. Now, Anderson used to represent a lot of charitable groups. They were, very charitable type organization, and that's why it's unfortunate that we lost them, because they were Chicago based. And so frequently, these nonprofits would want to have an Anderson partner on the board of directors. Now, what do you think was the primary motivation of the nonprofit? Why would they want an Anderson partner on their board of directors?
For prestige?
Expertise.
Well, that'd be a nice way to describe it. Bill's a little more, those are excellent answers. I'm a little more practical. They figure if they name an Anderson partner to the board of directors, Anderson will contribute contributions to the organization. I like the expertise argument and competency that you mentioned. I think it was a way of getting donations. So I'm sure a place like United Way probably had an Anderson partner on their board of directors, because then Anderson would contribute vast amounts to the United Way for their alleged charitable purposes.
So you can do that.
Now, the only where it would be precluded would be if you were involved in the audit of that particular organization. Now, Anderson had a big group of nonprofits. That was a separate audit group. So there, of course, that would not be allowed because you're involved in the audit of the organization. Yes, something I hadn't thought of, but Joan has it marked here, page 93. When there's a lawsuit or an intent to start a lawsuit between a CPA firm and its client, the ability of the CPA firm and client to remain objective is questionable. There's also a part in here that says if a client owes you money, you can't be independent. That could be from a prior engagement. They owe you money. That's all, that's on page 94, unpaid fees.
Personally, or, oh, okay.
Yeah, let me just read it from page 94. Under Rule 101, etc., independence is impaired if billed or unbilled fees remain unpaid for professional services provided more than 1 year before the date of the report. So if you're involved in litigation or involved with unpaid fees, you can't be independent. But let's be honest, is that a major burden? If a client hasn't paid you for last year's audit, are you going to want to do this year's audit? No. You know, one of the things we talked about last week was how you accept clients, or do you continue with certain clients. In some cases, if you feel uneasy about a client with regard to their ethical practices, you may want to drop them. If they owe you money, you may want to drop them. If you consider the client to be too small to justify your fees, you may want to drop them. So I know nowadays with medium-sized firms, they need the clientele. So they may not be willing to adopt that standard to as great a degree. But if there's unpaid fees or litigation involved, you don't have a choice. You've got to terminate the relationship with the client and then pursue the collections or the litigation. Now, Rule 102 is integrity and objectivity. This one could apply in a variety of scenarios. Now, when we go through some of the homework, I might have some disagreement on some of the answers. Sorry about that, that's Bill. Because this one could also accompany some other rules. Now, maintaining objectivity, that's also related to independence, isn't it? And having integrity, that involves conflicts of interest and things of that nature. So, when we go to the homework, and there used to be an extra problem, unfortunately it's not in this edition, some very interesting situations. There also are some questions on the midterm in this area that we may address a little bit as well. Rule 201, 202, and 203, these normally are not the answers per se to any exam type questions. These are basically broader, involving the generally applied standards for performing an audit. So we probably won't see those per se on an exam type question. Oh, Rule 301, confidentiality. You cannot share client data without what?
Information.
Their authorization. There are some exceptions. I used to think there were 3 exceptions. Our book lists 4. One of them, I want you to come up with independently.
Peer review.
Okay, well that's one of them. If it's part of a mandatory peer review, can you explain a little, Amanda, to us about what the peer review is? It's I was gonna say relatively new. It's probably been around for about 20 years.
Isn't it like a handful of firms, like, I don't know, it's kind of like not sampling, but there are a handful of firms are looking at different clients and they're basically auditing them and getting.
Well, what it is, let me explain, see what you think of it. A number of years ago they came up with this. This is not part of Sarbanes-Oxley. I believe we had this before. A CPA firm could apply to be a peer reviewer. And then they would be assigned to review some of the audit work papers of other CPA firms for different clients. And they would give an opinion as to the quality of the work. If they found the work satisfactorily, then that other firm would have passed the peer review. If they found major problems, then there would be a follow-up.
But the only way they can share it if someone's trying to buy out that actual firm. They can share it then, but they still can't disclose.
Well, that's another issue too,
Yeah.
is about that too. And you need authorization for, by the way, I used, and an exam question, when I wrote it, there was a multi-part question. And one of them said, you've got authorization to share the tax return working papers from the client. Can you also share the audit work papers? And the answer is no, they're all separate work
Yeah.
papers. So you got to get authorization. But one exception that Amanda gave us is for a peer review. How about this idea? I love you dearly, client, but I'm not going to jail for you. What's another of the exceptions?
Like subpoenas?
Yes, a subpoena or a summons. What should you do if you get a subpoena from the government to turn over all audit-related work papers for this client? Now, what you do now, let's say you're given 48 hours. What should you do right away?
Contact your lawyer.
Whose lawyer? I would contact the client.
Oh,
I would contact the client and have the client's lawyer say, listen, client, I've got 48 hours. I'm not going to jail for you. So you better quash the subpoena or take other legal action, because otherwise I'm turning over the papers that are requested in the summons or the subpoena. Exactly. So we have the peer review, we have the subpoena or the summons. What else?
A CPA firm is normally going to have lawyers too for them, right?
Oh, yes. And you should contact your own lawyer as well. But I would contact the firm right away, the client, and just tell, because let the client contact their attorneys. Because it's not going to be our attorneys, it's going to be their attorneys who are going to seek to quash the subpoena, if they can. They may not be able to. It may be an examination by the SEC.
so the subpoena would come to the actual audit firm?
It goes to the audit firm, exactly. I'll give it right here. Let's say Barry's the auditor, saying, please submit all audit work papers which you have prepared on behalf of XYZ company for the year ended. Then he's going to contact the client, say, I've got the subpoena. They want all the work papers for, let's say, a particular area. So I've got 48 hours. I'm complying within 48 hours unless you get back to me and can prove that you quashed the subpoena. I'm sorry, I wouldn't be ethical. I wouldn't be foolish enough to go to jail for a client. They're not that valuable. The other, I recall, there's a response for the Ethics Division of the AICPA. And the other one is the one I did not remember, is the obligations related to technical standards. I've never seen that one apply, but I've seen the others. Now, help me out, Rule 302, contingent fees. Now, this one disturbs me, and I'll mention why in a few minutes. Do we have contingency fees in the legal field?
Yeah.
Yes, they're very prevalent. For example, I'm your attorney, and you're having me represent you in a personal injury case. I get 1/3 of the recovery. What if we lose? I get nada, zero. But what about, we talked about this briefly last week, what about in the accounting profession?
No.
Which contingent fees did we say were banned?
Audit?
On the audit, where exactly, where the fee would be based upon the type of audit report that was issued. That, of course, is banned, but I'm going to go to the rule itself on page 98. One thing disturbs me here. Looking at Rule 302, well, it starts off, it is related to audit reviews, etc. But near the bottom, it says, solely for purposes of this rule, fees are not regarded as being contingent if fixed by courts or other public authorities, or in tax matters if determined based on the results of judicial proceedings or the findings of governmental agencies. That has always bothered me. I am your auditor, but I also can review your tax return. Remember, that's still allowed. And I say, you know, last year's tax return, you didn't take advantage of a, maybe, I don't know, the 179 deduction or whatever. Or you didn't take advantage of bonus depreciation, which could have saved you a lot of taxes. So if you hire me, I'll file an amended return for last year, and my fee will be 40% of the tax savings. Now, strictly reading this, that contingent fee would be allowed because it falls within the language, or in tax matters that the term based on the result of judicial proceedings or the finding of governmental agencies like the IRS. At Anderson, I had situations like that, but it was never taking a percentage of the tax savings. It was billing based on the number of hours spent. Now, if, off the record, if I came up with a special, let's say, planning procedure that saved the client significant dollars, maybe I would have worked a little more slowly so I can inflate a few more hours charged to the client. But we never did it on a contingency fee basis. It looks to me, though, in that area of tax, that would be permissible. I just don't like that idea, that's all. CPA firms are permitted to charge contingent fees for non-attestation services. Okay. Rule 501. By the way, there used to be some other rules that aren't in here anymore. There used to be a rule about incompatible occupations. If you work for one CPA firm, another CPA firm could not contact you to try and have you switch firms. That now is banned. They can't do that anymore. If one CPA firm knows that you're a partner at another firm, they can solicit you to join their firm instead. Rule 501.
Wait, they can?
They can do it now, yeah. You can hire people out of other CPA firms. You can contact people working at other CPA firms to try and encourage them to join your firm. That was banned for years. That is no longer banned.
That seems a little drastic. Not
That-
letting you go somewhere else?
Well,
Well, you know, like,
you could contact, as an employee, you could contact another CPA firm, but they could not contact you. And if you contacted another CPA firm, let's say you work for KPMG, and you contact PricewaterhouseCoopers, PricewaterhouseCoopers would have had an obligation to contact KPMG and say, one of your people is soliciting us for employment. So it kind of held you captive. That rule was repealed a number of years ago. Acts discreditable. Look how broad it is. A member shall not commit an act discreditable to the profession. Anyone with military background in here? Okay. Well, in the Uniform Code of Military Justice, remember Bill was a JAG officer in the Army, there's a provision that talks about conduct unbecoming an officer and a gentleman. I guess we'd have to include lady to it as well. That's so broad. Now, this would probably be decided by the state society. Let's say you were picked out. Now, there's some stuff here in the text here about, if it's an obligation that's a felony or involves possible criminal time served in prison. But the issue here really is determined on a state level. In the state of Illinois, if you're picked up a third time for DWI, would that constitute probably a Rule 501 violation?
no.
I think not, because in Illinois we know that our politicians, our athletes are frequently picked up for, alcoholism problems. or drug problems. In a state like Utah, would the Utah CPA Society probably consider that a 501 violation? Probably yes. Because remember, in Utah, there are no taverns. Now, there's private clubs where alcoholic beverages can be served, but there's restrictions on packaged goods and so forth. Now, I must confess, you could probably go into a private club and give a $20 membership fee, and that will entitle you to use their establishment. But it's determined by state determination. Rule 502, Amanda, you're the one who researched this for me in the online discussion?
502?
Yes.
I think I did.
Yeah, what are the three standards? Remember, we are allowed now to advertise as long as the advertising is not blank, blank, or blank.
So
What are the words?
can be deceptive.
That's one of them. Blank, deceptive, or blank. First one starts with F, last one starts with M.
False, misleading, or deceptive.
That's it. False, misleading, or deceptive. But the advertising is now allowed. Can't be false, misleading, or deceptive. Now, there's some interesting homework problems here. There's the one that says, we're advertising that we represent the 10 largest S&Ls, and our billing is 1/3 the billing of other firms. We'll talk about that when we get to it. Commissions and referral fees. Commissions and referral fees. What's the rule? This is Rule 503. What's the general rule? Are referral fees common in like the legal profession?
Yeah.
Yep. Let's say a client comes to me, I've had this happen. And it's an area I don't work in. So I refer the matter to another attorney who does work in this area. And I may receive compensation for the referral, which proves to be extremely lucrative for the other attorney. Now, here on page 100, they talk about commissions, first of all. Restrictions on commissions are similar to the rule on contingent fees. CPAs are prohibited from receiving commissions for a client who is receiving attestation services from the CPA firm. Commissions are permissible for other clients, but they must be disclosed. So if you're not doing the audit, you can get a referral fee or a commission. Now, notice the implications there, though. I'm doing an audit for a particular client, and there's a pension matter that comes up. Before Sarbanes-Oxley, I could have handled that. Now I cannot. So I refer the matter to a pension consulting firm. I cannot get a referral fee for that.
If you're doing the audit, right?
Because I'm doing the audit.
Okay.
I'm doing the audit. So now the other firm may owe me something, but maybe they can return it by, if they have a client who needs an audit and they're looking for an auditing firm, maybe they can send them to me, but there can't be any monetary consideration there. Rule 505, form of organization and name. A couple things I want to mention here. First of all, it used to be, the rule was very simple. If it was a CPA firm, all the owners of the CPA firm had to be what? CPAs. But they changed the rule. I thought that was a great rule. Now you can have non-CPAs who are owners of a CPA firm, but, page 101, the following rules apply to all non-CPA owners. Rule number 1, that's the key one. They must actively provide services to the firm's clients as their principal occupation. Back in the days when we called them secretaries, now that's like stewardess or waitress, all outmoded terminology. They were not deemed to be working directly and providing services to the firm's clients. So a secretary would not be entitled to be an owner of a CPA firm. Now, there used to be some restrictions. For example, in the name of a firm, I couldn't put down Expert Tax Service LLC because there was no way of measuring who was an expert. Now they've relaxed those rules. So you'll see some designations, perhaps for accounting firms that may include language of that type. There's a little table that summarizes these rules on page 102. Now, let's look at the problems. Okay. Have some fun with this. Okay, first of all, some basic ones. Rule 4-9 talks about the stock ownership. What did we say about, this is 4-9. What did we say with the rules as far as stock ownership with regard to partners and with regard to below partners?
So they're prohibited from owning any stock for partners, directly or indirectly, and then for staff.
I need a little bit more specific. You said they can't own stock indirectly or directly in a client. More detail.
In the office that they are appointed to?
That's right. That's right. That's the more relaxed rule. That's right. A partner cannot own stock of an audit client of the partner to which he or she is assigned. And for the non-partner level?
They just can't be involved in the audit.
Yeah, can't own stock in any particular client of which they could in any way influence the results of the audit. Are you chilly, by the way?
Yes.
God, I'm gonna have to bring some. I gotta bring something in next time, a towel or a sweater or something. Jeez, I can't see my breath. Back in when we used to have classes in the Oprah, the big tower, and we had some classrooms on the second floor. Most of our classrooms were in a higher floor, and there was a room there where you could have hung meat from hooks. You could almost see your breath in there. It was a great room, but there was something wrong with the temperature controls. Okay, any other questions about ownership, stock ownerships from what Amanda indicated? And again, that's a topic I added to the online discussion today. Okay, then we have 4-12. This is the rule about contingents. This is interesting. Assume that an auditor makes an agreement with a client that the audit fee will be contingent on the number of days required to complete the engagement. Is that a violation of the code? What is the essence of the rule dealing with contingent fees, and what are the reasons for the rule? The fee will be based on the number of days spent on performing the audit.
What page are you on? I'm sorry.
Page 105, question 4-12.
So,
105.
I think it is a violation.
Anyone else think it's a violation?
Well, isn't
Go ahead, Lena.
the number of days similar to the number of hours? So no, it's just billing them by days instead of
That's
hours.
right. That's right. This question's been in the book for years.
It's kind of
and
silly.
the normal reaction I get from students is it's a violation. No, it's not. Lena's right. That's the way an audit fee is determined. It's the people working on the audit, the number of hours they put in times their billing rate per hour. So isn't that kind of deceptive, though?
It's a
So
stupid
no
question.
violation. This is the way in which fees are always established for performing audit. It's not a Rule 302. It's not a violation because we're not basing the fee on the results of the audit. We're basing the fee, as Lena points out, on who performs how many hours on the audit times their billing rate. Very good.
So this is the way the fees are just set up. Is what you're
That's right. That's the way fees are always set up on an audit. Okay, one more less exciting one, then we'll get more excitement. 4-13. This is the one relating to confidentiality. Give 3 exceptions to the general rule. Again, what was the rule number for confidentiality? What was the rule number?
301.
301. 301. And it said you had to have permission